Hi, everyone. It's a pleasure to be back here to discuss an update on Project Libra. I'm Christian Catalini, one of the co-creators of Libra at Economist at Novi, and a professor at MIT, currently on leave. Feel free to post your questions in the live chat. I will try to answer them as we go. First, a distinction. So as you know, Libra is now an independent organization where Facebook is actually only one of 27 members. That means about less than 4% of the governance and voting of the entire organization. There's a number of different entities contributing to the growth and success of the ecosystem. On the other side, Novi is a digital wallet that will be provided by Facebook and will integrate with the Libra payment system. So I want to draw that distinction since it will be useful through the content of the talk, which will actually focus on the economics of Libra. As I mentioned to you, and those of you that attended last year, the journey has been really a journey around developing a new model for trust in digital platforms. And this really goes back to work that I had done with my co-author, Joshua Gans, on really thinking through, what does it mean that you can use blockchain technologies and cryptocurrencies to develop new forms of interaction, economic interactions, and new models for market design in digital platforms. At the time, we were focused on kind of two dimensions, two key costs: the cost of verification and the cost of networking. The second one is really closely related to the efforts behind Libra and essentially building distributed governance on an infrastructure that can support payments and also later financial applications on a global scale. Now, there's at least three main objectives in the economic design of Libra. The first one is to build trust in an efficient medium of exchange and the payment network. And it's often talked about across a number of different topics, from macroeconomic policy and others. The second one is the resulting market on top of the Libra protocol, and ensuring that there's competition and interoperability at the core of everything the network stands for. The last one I want to also expand on today is really that trust in the governance and future evolution of the network and some of the journey that we've done since the original white paper. There's a number of key updates in the economic design of Libra, from, of course, the introduction of single currency stablecoins. I'll expand on that in a second, to kind of changing the future transition to permissionless, while at the same time trying to replicate the core economic properties that we I think all of us appreciate in permissionless networks within the Libra framework. There's also a number of improvements to the Libra reserve, and this is kind of really spurred by extensive feedback that Libra has received from reports like the G7 stablecoin report or the FSB work on global stablecoins. Now, let's start with the trust in the efficient payment network. As I was mentioning, now there's two types of Libra coins. There's the single currency stablecoins. Think about something like a Libra dollar, Libra euro, Libra pound, but also the network is retaining a concept of a multi-currency coin, LBR, although it's fundamentally changed from the one of the original white paper. The new LBR will be essentially a digital composite of some of the single currency stablecoins available on the network, and I'll tell you a bit more on how that works. So on the single currency stablecoin, this will actually enable a number of additional use cases. As you may know, the original goal was to support cross-border payments like remittances, but with the introduction of single currency stablecoins, a number of domestic use cases in the relevant markets also become possible. Like in the original white paper, each one of the single currency stablecoins will be fully backed, so one for one, and I'll get actually to some details on how it will be over-collateralized to really absorb potential losses on a number of potential risks and dimensions. And how people, users, consumers, and businesses will interface with the reserve will really be supported by a competitive market for resellers and exchanges that will be buying and selling these coins to and from the reserve. Now, over time, this new approach also allows maximum flexibility to central banks around the world to think about how they want to integrate with something like the Libra network, how this can support their efforts in upgrading payment systems, and more broadly, the journey towards hybrid CBDCs, synthetic CBDCs, or wholesale CBDCs. The goal is really one where, as soon as some of these public sector efforts become available, Libre could stop operating the relevant reserve and replace it with the public sector asset. So really think about Libre as this layer on top of whatever the public sector will do in these spaces that enables a range of new functionality and a range of new features for low cost, low frictions, instantaneous payments, both domestic, where the single currency stablecoins are available, and cross-border when they're not yet, on the network. Now, the multi-currency Libre coin, it's kind of redesigned in this new version of the white paper. It is now essentially just a digital composite. Think of it as aggregating together in fixed nominal weights, so fixed amounts, some of the single currency stablecoins available on the network. Now, because each one of the single currency stablecoins is fully backed, as a result, the multi-currency Libre is also fully backed. It's also not really a separate asset from the single currency stablecoin. It will not be minted and burned by the reserve. It will be just stapled and unstapled by some of the participants operating on the network. Now, this design is actually similar to the special drawing rights maintained by the IMF. And over time, the goal is really to pass oversight and control of the composition of the multi-currency Libre coin, potentially to a neutral third party, such as the IMF or the group of central banks involved in that particular composition. Now, since it's not a peg to any single currency, as the value of any one of the components moves, the value of the multi-currency LBR will move with respect to any local currency. Here on this slide, you're looking at some of the potential flows. So if you imagine maybe two countries, let's say the network has a Libre dollar and a Libre euro, and someone is trying to send money from the US to Europe, that transfer could start in Libre dollars, would go through likely a wallet, exchange, or financial intermediary to perform the conversion. This is not happening actually on chain. And the receiver would receive it in Libre euro, and potentially they could spend it on merchants, local goods and services in their own country. Now, if the receiving country does not have a single currency stablecoin on the network yet, they may decide to receive this in any one of the currencies available on the network, including the multi-currency LBR. Why would they use maybe the multi-currency LBR? Is because you can think of it as a neutral, low volatility option with respect to a number of potential jurisdictions. And in Flow C, you're looking at two countries that do not have a single currency stablecoin on the network yet. That flow could start in LBR, could arrive in LBR, so no conversion needed. And of course, when the person receiving, for example, that remittance flow wants to spend it, they would convert it into local fiat using a cash in and cash out provider. So as you see, this new design is much more flexible and enables a range of kind of new use cases on how the network could operate in different jurisdictions. The other effort that's currently underway is really adding additional protection in the design of the Libre Reserve. And here we're really trying to break new ground into the design of stablecoins in general. The G7 stablecoin report, as well as the FSB report, raised a number of issues and questions around what happens when stablecoins experience extreme market situations, very much like what happened after the COVID outbreak or in 2008. And so the structure and administration of the Libre Reserve is now designed to really mitigate those threats and allow for value preservation of coins over time. Here, we're really importing the best practices from the financial sector. Think about the Basel framework and other relevant frameworks that are used to really think about a number of potential losses that something like a stablecoin could incur. This could be losses from credit risk, market risk, so changes in interest rates, or operational risk. Like any endeavor, there's always dimensions of operational risk. And so this is something that we did a lot of work in the last months, working towards a framework that can really provide strong guarantees to coin holders and businesses operating on the network. Now, of course, all of this really starts with transparency and auditability. The reserve needs to be not only audited on a regular basis, but that information about the backing needs to be transparently communicated in practically real time to the public. So that will be a really important dimension for building trust in the coins. There's also, as I was mentioning, work on really the regulatory capital requirements and regulatory buffers. The intuition here is that the buffer that the Libre Reserve will maintain will grow as both the assets grow in risk, maybe because there's a change in market condition, or as the reserve size itself grows in time. Without getting into too many of the technical details, this is pretty standard, but like there's going to be a component of a Pillar 1 requirement that Libra will be expected to maintain at all times, and additional capital buffers under Pillar 2. How will the network fund these requirements? Well, like any other business, to retain earnings or through capital that's raised from its investors. Now, often people ask, how will Libra be able to support, stable coins in currencies that face negative yields? We can think about a Libra Euro, for example. Well, the short answer is that it will have to cover these costs through additional revenue streams. It could be additional transaction or other fees that are introduced on the network. If there is positive interest on the reserve asset, of course, that can be used to cover OPEX and other expenses of the Libra Association and really ensure that the network operates smoothly. Think about supporting validator cost and other dimensions of that type. And as before, Libra coin holders will not receive any return, positive return from the reserve. Now, there's a lot of additional work that is currently underway from really ensuring competition and transparency in the market for designated dealers. These are, after all, the key interface between the ecosystem, VASP operating on the network, like wallets, exchanges, and others, and the reserve. And also defining a traditional recovery and resolution plan, including things like a standby administration dealer and really processes for handling redemptions under very extreme market conditions. We're also working on other dimensions like substitution risk, when it comes to emerging economies, and really thinking about how can countries take the best advantage of flows like remittances without worrying about interference with monetary policy. The broader idea is really to support integration with public sector efforts in this space. And really the future that we're trying to build towards is one where, as soon as I was mentioning, the public sector is either upgrading their RTGS systems or opening up some of those interfaces, or is exploring anything that looks like a synthetic CBDC, retail CBDC, or wholesale CBDC, Libra can integrate with those efforts and stop even operating a reserve. Again, the focus of the network is in delivering payments and functionality around payments and financial services, not running a reserve per se. But that's kind of a necessary step in this phase where these assets are not fully digital and programmable on the public sector side today. Now, I mentioned this actually in my presentation last year, but another key dimension, and one of the reasons why we landed on this particular design for Libra, is that we want to ensure that there's a thriving and competitive market for financial services and payments on top of it. And we really want to avoid vectors of concentration. As you probably know, many of the consensus algorithms and pieces of consensus algorithms used today lead to different types of forms of concentration. For example, in proof of work, you have concentration in mining. In proof of stake, you have concentration because of initial seeding of capital among some of the participants. And so here we're really trying to strike a balance where, when you think about why are there Libra Association members, well, they're really important for driving, of course, utility and use cases in the network, but they're also solving the classic nothing at stake problem that traditional proof of stake networks typically face. These entities are bringing their reputation on the line, and by running validator nodes, they're ensuring that the network is safe in some of the phases where you could think it's actually the most vulnerable. Now, what's really important is that this network keeps staying extremely competitive, and it's not a walled garden. The model is really that of the open technology standards of the internet. And I'll expand more around this in a second, but it's extremely important that there are open and transparent membership criteria, both for, for providing validator services and eventually also for governance. The goal here from an economics perspective is really to ensure extremely low switching costs for consumers and businesses relying on the network, low barriers to entry, and extremely high interoperability. At the end of it, building interoperability is probably one of the most important missions of this project if you want to get a financial inclusion. We believe that more competition would lead to lower prices, better quality, and also the development of a number of new services and business models that are difficult to predict today. Now, in the last part, I want to talk a little bit more about one of the most complex dimensions of trust, which is trust in the governance and future evolution of the network. As I was mentioning before, Facebook, that incubated some of the original ideas around this project, is only one of 27 members. So can only exert one vote out of 27 in total. And this will keep expanding, of course, over time. And as I mentioned also in the past, an independent and strong association is really a key prerequisite for the success of this project. Founding members, of course, are needed to drive utility and adoption, secure the network by running validator services, and really bootstrap this kind of market for delegation and reputation around the project. The economics are really similar to those of standard setting organization, and the goal is really one of distributed governance. That will encourage individuals and organizations to build on the same ecosystem rather than reinforcing and increasing fragmentation, which is a known problem in payment and financial services. Another key objective of the association is also, of course, avoiding a tragedy of the commons where everybody tries to build on layers on top of the base layer, the shared layer by everyone, and doesn't contribute enough resources back to the investment in what really constitutes a public good and shared infrastructure. Now, we began the Libre journey by describing a shared vision, and this, of course, would have needed new technology to transition the network to a fully permissionless one. And that vision was really inspired by some of the key economic properties of permissionless networks. So what happened is that one of the concerns that we heard from regulators about that vision was that we were introducing a number of additional provisions, from AML to compliance, to really ensure that the network is safe and is good at fighting financial crime. And regulators were concerned that if the network were to fully transition to permissionless, those provisions could be removed. And so you wouldn't be able to guarantee the health and integrity of the network in a fully transitioned way. Now, what we discovered through this process was also that we believe it is still possible to replicate the key economic properties of permissionless systems through actually traditional market design and auction design, and essentially through an open, transparent, and competitive market process for the provision both of network services, again, think about entities that want to run a validator, but also for governance and membership in the association. As you may know, Libra is building on BFT through hot stuff, and the BFT consensus protocols have a number of advantages in terms of throughput, latency, and the no need for wasteful computation, for example. There's additional good features around finality, but at the same time, as an economist, one of the things that worries me the most about BFT is that, of course, the security depends on the quality and the incentives of those initial validators. You're essentially trusting them with the operations of the network. And as we know, incentive alignment around all of these issues is and can be very hard. Now, the network, of course, is a public good. It's a shared infrastructure. And so you often run into a tension between some of the short-run objectives. Think about the needs of the network in its early days when you're trying to bootstrap it and increase utility, versus more long-run objectives. So allowing for additional validators or additional governance members to come and compete with the existing one. And so the next steps of the Libra process are really trying to drive a balance to really ensure competition for services and governance within a framework where nodes and validators will need to be compliant. Now, the good news is that we can really learn from market design and other economic systems that really face similar problems, where you do have a trusted set, but you're also trying to introduce market forces within that set. We believe that competition is a prerequisite, again, for building a highly interoperable, efficient, and especially innovative payment system. So at any point in time, new entrants need to be able to compete with the existing players within the Libre ecosystem for not only the provision of payments and financial services, this is both to businesses and consumers, but also the opportunity to run independent validator nodes to contribute to security, reliability of the network, and also through introducing less correlated failure risk. The most difficult one on the dimension of competition is really active participation in the governance and the evolution of this project. So the first two, the first one is already achieved by the fact that, again, the entire network is modeled after an open technology standard, but items number 2 and 3 really require working on this market-driven process that will allow new qualified members to enter and compete with the existing ones. And this is really a novel concept that we're bringing, I think, to this space. So what may this look like, right? Again, together with the non-transitioning to permissionless, these become really the key step for ensuring that you do have an open and transparent and competitive market for resources and for governance. This applies to both the phase of expanding membership in the association and also renewing membership. And I'll give you a little bit more details in a second. The goal is really to offering new entrants the ability to compete on all of these dimensions, while at the same time ensuring that Libra Association can meet and upheld its values on regulatory expectations on issues like AML and compliance and so on. So when you think about expanding membership, you could imagine a process, and again, this is still work in progress with the membership, where there's a series of open calls, and the association declares how many membership slots will be available in each round. There'll be some objective dimensions, like the application could cover things like basic information about the applicant to really ensure that it meets the compliance bar, as well as technical information. Would the applicant be able to successfully run a secure and stable validator node? And then more nuanced dimensions like economic performance. Is this an applicant that will really contribute to the further growth of the ecosystem? And of course, to ensure that there's funding for OpEx and other dimensions of the association, there could also be a financial contribution in this. You could use this information to essentially calculate a transparent membership contribution score. This is used often in other kind of application processes. Of course, these terms, for calculating such a score should be public before an open call is run. And this is actually used in a number of allocation mechanisms today. This would ensure that any potential entrant can use this information to decide if they want to make an investment in the Libra network and kind of start becoming a validator, or maybe even becoming a member of the governance or not. Similarly, you could use a similar process, which is essentially using auction design to rank potential slots and entrants, also to kind of renew the membership set and ensure that it can really keep innovating and advancing over time. Of course, all of these decisions would have to be made taking into consideration any antitrust or any competition issues, as well, of course, the regulatory compliance requirements, which are really the entry point for participating in a network of this type. Now, I want to spend the last few minutes to kind of go back to the broader mission, which is really to enable equal access to financial services. Interoperability, lower cost, lower frictions, I believe can make a massive progress, both in domestic markets, but especially in cross-border. Too many people today really don't have access to basic payments and financial services. And the irony is that often there's large segments of the population, so 1 in 9 people globally, are often supported by funds that they're receiving through a remittance from family and friends. The aggravating factor is also that people with less money tend to pay more for financial services today. And the World Bank estimates that you've probably heard before is of approximately a 7% cost for sending money across borders. So that means that if you're sending $200, approximately $14 are lost to the intermediary. Not only you're spending a lot of money in some of these cross-border flows, but transactions also take time. So these are not immediate transfers. In some cases, it can be multiple days before someone receives money on the other hand. I believe the COVID situation has made this even more salient, where you've seen a number of governments struggle even in stimulus payments or in getting money in the hands of their citizens within a reasonable time frame. And the situation is likely to be more aggravated as we enter kind of a very long and potentially painful economic recovery phase. Now, the good news, which I'd mentioned also last time, is that yes, there are approximately 1.7 billion people without a bank account, without access to low-cost payments and financial services, but a large number of these have access to a mobile phone, and the majority of that subset has access to some form of data. And so there's a lot that can be done by bringing a network that's truly interoperable, that favors competition, and can allow a number of startups across the globe to enter with new services and new options for consumers. I look forward to your question and thank you very much for your attention.